Hello and welcome. Today I'm sharing how to find high probability bullish and bearish pressure areas using simple price action, and I will reveal how to day trade these zones in multiple market scenarios. So if you could, like, subscribe to the channel and stick around for the full video. Candlestick shadows can tell you a lot about the market psychology of market participants and should play an important role in your analysis. Long upper shadows are considered bearish shadows. The presence of one or more bearish shadows after a price advance demonstrates that the market could possibly reaching a top. There is not enough demand at higher prices to continue to move the price upward, at least for the short term. Long lower shadows are considered bullish shadows. The formation of one or more bullish shadows after a price decline, especially near support, shows us visually that the market could be reaching a bottom. In this case, the wick indicates that lower prices are being rejected. I've said it in a previous video, markets are traders making trading decisions. If you really want to succeed at day trading, when you look at the chart, don't see it as price movement. See it as traders making decisions. So let's analyze 3 stages of a Pinbar from the perspective of other traders. How do traders react to this bar during and after its formation? The best way to examine this price bar is to consider the perspective of traders who transacted at the extremes of the bar. Group 1 sold at the bar high. Group 2 bought at the bar high. Group 3 sold at the bar low. And Group 4 bought at the bar low. Traders who sold at the high of the bar in stage 1 felt like geniuses in stage 2. Then, they quickly became frustrated as the market moved higher and raised their profits. Traders who bought at the high of the bar in stage 1 were constantly watching the bar erode their trading account. Stage 2 was the worst time for them. In stage 3, they felt relieved when the bar ended the way it did. Traders who sold at the low of the bar in stage 2 are in the worst case scenario. The market didn't move a single tick in their favor. Traders who bought at the low of the bar in stage 2 are the happiest. They didn't suffer a single tick against them. So in the case of a large wick candle, we have 4 types of traders. Sellers who are scared, likely to cover shorts. Buyers who are optimistic, likely to hold longs. Sellers who are demoralized, likely to cover shorts. And buyers who are confident, likely to hold longs and even add more. So why is this important? Well, together, they are likely to produce buying pressure. The traders who are short want to cover, so they are creating demand. The buyers want to hold, so they are not supplying, at least not without demanding higher prices. The result is a pressure on the market to move up. So the lower shadow reflects the amount of buying pressure. Your job is to locate the buying and selling pressure zones implied by the lower and upper shadows of price bars. Although in the previous case I used the Pinbar as an example, a strong pressure zone is not defined just by one Pinbar. To find high probability pressure zones, you must not be particularly interested in how a single bar looks. You must pay more attention to the appearance of a group of price bars. So the buying or selling pressure found on a single price bar might not be sufficiently reliable for a trading setup. Therefore, instead of a single bar, look for at least 3 consecutive bars with overlapping upper or lower shadows. Remember, shadows indicate potential buying or selling pressure. When shadows overlap, they create a price zone that is more likely to exhibit the buying or selling pressure you anticipate. Consider the perspectives of the 4 groups of traders again. When we have 3 consecutive bars with overlapping lower shadows, the traders undergo the same emotional cycle 3 times, all within a compact price range. That price range is the pressure zone we are looking for. A bullish pressure zone is easy to identify. You can mark it out as a zone on your charts. Find 3 consecutive bars with overlapping lower shadows. Mark out the lowest low among the 3 bars. Mark out the lowest closing price of the 3 candle bodies, so exclude the shadows. and the area between these two price levels is the bullish pressure zone. To find the bearish pressure zone, find 3 consecutive bars with overlapping upper shadows. Mark out the highest high among the 3 bars. Mark out the highest close of the 3 candle bodies, exclude the shadows. And the area between these 2 price levels is the bearish pressure zone. Very important, small overlaps of shadows can create unreliable pressure zones. To avoid them, ignore overlaps between a certain threshold. For trading higher timeframes, 1 hour or above, consider increasing the threshold as necessary. Here's the long pressure zone trading plan. Find a bullish pressure zone. Buy above the next bullish bar that overlaps with the pressure zone and closes above it. The 3rd bar of the pressure zone is acceptable if it's bullish. If the price returns once again to the bullish pressure zone and forms another signal candle, you can re-enter. This is similar to supply and demand trading. If price breaks below the pressure zone, the setup becomes invalid. And here's the short pressure zone trading plan. Find a bearish pressure zone. Sell below the next bearish bar that overlaps with the pressure zone and closes below it. The 3rd bar of the pressure zone is acceptable if it's bearish. If the price returns once again to the bearish pressure zone and forms another signal candle, you can re-enter. And if price breaks above the pressure zone, the setup becomes invalid. Here we have an uptrend. This swing high maintained the excellent bullish momentum by moving above the previous swing high. After such a bullish move, expect the market to react with some bearish or sideways action. This low that formed couldn't close below the previous pivot low, implying that the uptrend is still intact. And here's our bullish pressure zone. These consecutive wicks signify that sellers were able to push the price down. Bulls drove price back up, showing strength. Since bulls overpowered the selling pressure by bears, there is the potential that their strength will carry forward, leading to an upwards movement in price. This is the signal candle, which overlaps with our pressure zone, so we buy above it. The low of this extended wick provides a very prudent level for you to place your stop. The rationale for that stop placement being that sellers pushed price to the low of that wick, but couldn't push it beyond that point. Hence, placing the stop just below that wick is a level that has a lower likelihood of getting hit. And how do you know when to exit? This is probably the most difficult question to answer. It will depend based upon your risk tolerance. Sometimes it's best to take your profit quickly and walk away. Other times, you want to take some money off the table, move the stop to break even, and let the trade run. This discretion will be up to you. This example shows a bearish pressure zone setup. These 3 bars formed the pressure zone and gave us an opportunity to short the market. This was the setup bar, as it overlapped the area and was also bearish. The short trade has a decent follow-through, and as the market pulled back upwards once again, this was an excellent option, especially for traders who missed the first bearish pressure zone setup. The advantage of this strategy is that the pressure zone places less emphasis on the length of a single shadow and instead focuses on multiple shadows to find reliable signals of bullish or bearish pressure. But this price pattern has an important drawback. Consecutive bars with overlapping shadows also occur frequently within congested markets. Instead of taking signals and trades all over the place, the better trades usually happen at key price levels and when you take volume into account. So location of the pressure zones and volume are very important to filter those bad zones that are offering false signals. A good filter would be a common moving average. The 200, 100, the 50 period moving averages, or even the VWAP are worth having on your charts when it comes to finding key pressure zones. During ranges, moving averages lose some of their validity, but during trending markets, you'll see that those moving averages will work very accurately. So try to buy bullish pressure zones above a common moving average and sell a bearish pressure zone below a common moving average. Higher timeframe support and resistance levels add a great layer of additional confirmation and confluence to these pressure zones. I especially look for strong and impulsive turning points where price has previously shown a strong reaction, because it implies that there is a lot of buyer and seller interest in such an area, and price is likely to show another reaction as well. Trend lines and channels are also great confluence areas. Trend lines are especially valuable if you are looking for potential pressure zones during trending markets when it comes to finding re-entry opportunities during pullbacks. When it comes to drawing trend lines, go for the most obvious ones with the most touches. My favorite dynamic support and resistance levels are pivot points. Pivot points are based on the previous day's high, low and close, so they don't change throughout the current day. I mostly pay attention to the central pivot point and S1 and R1 levels. So when you spot a pressure zone that forms at the pivot level, that's a high probability trade. Also, the take profit aspect becomes much easier. You exit a part of your position at the next pivot levels. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.